Let me ask you one question. Did you buy one of the safe tech bets like Bitcoin, Tesla, Coinbase, or Shopify? One of those great assets that will never go down again? Yes. Then you probably did realize the massive downturn since November 2021. When the public markets go down, usually IPO windows are closing. Funds like ARK funds also deploy less capital in new companies, and also industrial partners are not so keen on buying. The reason? It's quite simple. It's fear. When nobody knows what's next, it is often the best to do nothing. The big question here is, will there be sufficient venture capital for new startups in future? David Friedberg has an answer to that.
Over the past decade, as you guys know, there have been more venture money raised than at any time in history. The numbers have been going up every year, the number of funds, total capital raised. But at the end of 2021, if you look at the total funds raised and the total capital deployed by venture funds, we have a $230 billion capital dry powder hangover. So Amazing. there's a quarter trillion dollars of cash sitting in venture coffers that they can call and write checks into. So I think it provides a really interesting contrast that sets us up for a dynamic over the next few years on what's going to happen in private markets. Because you're going to have the haves and the have-nots. The haves are going to have a lot of friggin' money available to them because these venture funds need to be deployed over the next few years. The have-nots are the ones that don't have proof points to a viable outcome in their business. But the haves are going to have a lot of capital available to them.
With one caveat.
The big question is this really true? Venture funds don't invest their own money. They deploy other people's capital, called limited partners, or in short, LPs. Is it smart to call in capital when everybody tries to manage what's left over? Jason Calacanis and Chamath Palihapitiya reflect on the reactions in the big crisis in 2000 and 2008.
With one caveat. Which
pricing
is
and valuation. So what do you guys think will happen?
Well, no,
right?
There's two caveats.
In the contrast of everyone saying, hey, there's no capital available, that's not true. There's more capital than has ever been available. So how does it get allocated?
So the first thing is, to Chamath's point, at what valuation? And so there's going to need to be discipline, and you're right, that money will go to the winners. Other thing to remember is during the great financial crisis, for about a year, maybe even two, many venture firms did not want to call capital from LPs whose portfolios were crushed. And LPs said, I know we're on the hook for this, but I would appreciate it if you don't make a ton of investments right now, because we don't want to clear our already, demolished portfolios to then fund your venture fund. So those are commitments. It's not cash in the bank. And those commitments only come from Harvard, Yale, CalPERS, Ford Foundation, whoever, Morello Sloan Kettering. If the GPs can ask the LPs for that, and the last time this happened, and I don't know if it will happen this time, but I think you remember it too, Chamath, the LPs specifically said, hey, pump the brakes.
Yeah, let me build on what you said. In 2000, the more extreme measure happened, which is that most of these venture investors returned the money and just canceled and tore up the LPA. Mm-hmm. Now, why would they do that? Why would you tear up commitments for $250 billion? It's because your portfolio is trash. Meaning, if you have made a bunch of horrible investments that you know are now totally upside down, you have a responsibility to manage those investments to a reasonable outcome and ideally even try to get some salvage value. And so, it's very hard for you to look at an LP in the eye and all of a sudden say, you know what, I'm going to deploy this fresh capital and I'm in a psychologically good state of mind to do that well. And I think that what history shows is that when you have these drawdowns, the money is made by new entrants or fresh capital, which doesn't have the legacy of a bad portfolio. The returns are not captured by the same people. And the reason is because they have the psychological baggage of a horrible portfolio or horrible marks. In moments like this, I would ignore all of the dry powder and all of that stuff. I think that there are a lot of venture investors today who've deployed way too quickly. And if they want to have any reputation over the next 10 years, we'll have to rehabilitate their portfolio.
Dry powder, capital left in funds not yet deployed, or capital that can be called in from LPs, limited partners. But is this dry powder really the key metric and the key driver in the upcoming years? What are the dynamics that drive the venture market? Listen to the besties.
Since 1994, okay, just guess, how many funds, private equity growth venture funds, even existed that are greater than $1 billion? So this is over, 30 years, say.
What do you mean?
How many funds do you think even existed over $1 billion since 1994 to today? How many funds?
Like how many funds have been raised that are over
individual
$1 billion?
funds or the brand names?
Yeah. Since 1994, how many do you think there are?
40?
50.
1,276.
Oh, you're including private equity and stuff.
Oh, that was venture. Yeah. Okay, sorry.
Okay, so now of those 1,276 private equity funds or growth funds or crossover funds or venture funds, how many do you think have actually managed to return more than 2.3 times the money? 2.3 times.
10%.
10%, 5%.
22 of them.
It's like under 2%.
Under 2%. Wow.
So here's the point that I'm trying to make.
Yeah.
Investing is very hard. In an up market, everybody looks like a genius. All of these funds come up with all of their nonsensical ways of showing IRRs and all of these fake gymnastics. But the truth is in the data. And what the data says is that in the last 30 years, the minute you get over your ski tips at $1 billion, very few people know what they're doing. Very few.
It's hard. The multiples compress as you get to bigger deals.
And you
early
can't
stage
deny
is where the value is.
You cannot deny this numerical truth.
Yes.
So again, I go back to, the person that's always been talking about this and who again may be proven right yet again is Bill Gurley. Everybody would make fun. Why is Benchmark only raising $450 million? Why would they only raise $500 million? And they always were consistent because over the last 30 or 40 years, over multiple cycles, we have seen that this is the best way to optimize both for return and for mental clarity and for making our LPs happy. Every variable was optimized at around 550.
Focus.
And then you see $5 billion, $6 billion, $10 billion funds funding $5 billion, $6 billion, $10 billion, $20 billion private companies. And I think what we have to do is put two and two together and realize that it's going to be very difficult sledding from here for a lot of folks. And when the venture or crossover investor has this mental baggage that they're dealing with, they're not going to be able to provide fundamentally sound advice to the CEO. They're going to optimize for making that portfolio, tourniqueting the bleeding in the portfolio. The CEOs will make a bunch of suboptimal decisions. It'll probably lead to a bunch of layoffs, bad technology decisions, things slow down, and the cycle is reflexive in that sense. And so, we're going to go through a few years of sorting this thing out.
Down rounds, liquidation preferences, nonsense. Sachs?
So since we learned that there are only a few funds that historically created positive returns once they've raised more than $1 billion, what's the ultimate venture success model? Here you get the answer.
Will be.
Yeah. So look, I agree with that point that these mega funds are very hard to repay because they require you to have multiple winners, and not just winners, but mega winners. So, we've always kept our funds in that $500 to $600 million range where you really only need one winner per fund to basically return the fund. But let me go back to this point about
Can you
dry
explain
powder.
Explain the math of that? You typically own 15-20% of a winner. So just walk us through the math.
Maybe even less by the time that it reaches an exit.
Yeah.
Right, exactly. So, if you own 10% of one decacorn, that's $1 billion. And if it's a $500 million fund, you've doubled your fund. But if it's a $1 or $2 billion fund, you haven't even paid back the fund yet. So this is
and how hard is it to hit a decacorn?
Hard. It's hard. Right?
It's hard.
Real hard.
Really hard.
Real
I
hard.
hit two.
Yeah.
I've had two in a decade.
Have a great day.